Right now, the silver market is basically a coiled spring. We're seeing this period of extreme calm, this incredible compression, that's really a stark contrast to its usual volatile self. So today, we're going to deconstruct the key metrics driving this and analyze the serious pressures that are building just under the surface.
You know, in the markets, just like in a good story, a long period of quiet, well, it's often the calm before the storm. And that's exactly what makes the silver market so fascinating to look at right now. The fact that there's no noise is in itself a huge piece of the puzzle.
And this all leads us to the big question we're trying to answer. What are the real drivers behind this stillness in the market? Are we just seeing a consolidation before a massive breakout? Or is this some kind of new, quieter trading environment? Let's dive into the evidence.
So what does quiet actually look like when you look at the numbers? Well, the market's gone almost completely dormant on two really critical fronts, the daily price range and the total trading volume. Let's break it down.
The scale of this compression is, well, it's pretty staggering. I mean, just a few weeks ago, we were seeing silver swing $20 in a single day. Now, that has just collapsed into a super tight band of only about $3. That is a massive reduction in day-to-day volatility. And here's the other half of the equation. This price compression is happening at the exact same time as a collapse in trading activity. Just look at the recent volume on the COMEX. It dropped to just over 71,000 contracts. If you exclude holidays, that is the lowest level of participation we've seen in 2 months. So you put it together, low volatility and low volume, it really feels like the market is just holding its breath. But here's what's interesting. Even with all this inactivity, the market has been incredibly disciplined. For the last 2 weeks, trading has been stuck inside this very well-defined technical channel. The support level down at $70.86 has held firm, and the resistance up at $90.51 hasn't even been challenged. So the key takeaway here is that while the market is quiet, it's also, for now, stable within these key boundaries.
Okay, so that's what's happening on the surface. Now we're going to peel back a layer and look at the underlying mechanics of the COMEX futures exchange, because a really critical deadline is fast approaching.
To really get what's going on here, we have to understand this term, first notice day. You can think of it as the moment of truth for a futures contract. It's the point where a paper derivative can suddenly become a real demand for physical metal. It's a key date that forces everyone's hand.
And here's the kicker. That date is right around the corner. For the big March silver contract, first notice day is this Friday, February 27. This suddenly takes that quiet market we were just talking about and puts it up against a hard deadline, which creates a whole new level of potential tension.
Now this is where it gets really interesting. When you dig into the COMEX data, you see this key divergence. On the one hand, open interest, that's the number of contracts still open, has dropped by over 35% in 2 weeks. That's pretty normal ahead of a delivery month. But at the same time, the inventory of registered silver, the actual metal that's available for delivery, has also dropped by over 10%. So think about that. Even as the number of claims on physical silver is going down, the actual stockpile available to meet those claims is shrinking too. That reduces the slack in the system and creates a major underlying tension in the physical market. If you find this analysis valuable, please like, share, and subscribe to our channel so you don't miss future updates.
All right, so let's put all the pieces together. This combination of a super compressed market and this looming delivery deadline, it points to several potential outcomes. Based on the data, we can boil them down into 3 key risks to keep an eye on.
First, there's the risk of an engineered sell-off. You could see some major players try to push the price down ahead of the deadline. Second is actually the opposite risk, a counterintuitive move. You know, market history is filled with examples of when everyone expects one thing to happen, the exact opposite occurs. And the third scenario is that this all just turns out to be a non-event. The deadline passes, the quiet continues, and the market just kicks the can down the road.
So this leaves us with the ultimate question. The evidence clearly points to a market that is coiled for a move. We've got this extreme compression in volatility and volume set against a backdrop of shrinking deliverable supply and a very hard contractual deadline. So is a significant price move now inevitable? Or is the market just settling into some kind of new, quieter normal? The data has set the stage, now we wait for the market's response.